The Australian stock market was rocked by movement in global tech stocks this week, while there have been plenty of other pressures, including supply chain issues, panic buying and supermarket sale limits. Suzanne Haddan is Managing Director of BFG Financial Services and joins us now. Welcome to Weekend Breakfast.
Good morning.
Let's start first with the global tech stocks and the havoc that had on the Australian market.
Well, certainly we started the week at a certain level and ended the week at the same level. But during the week, Thursday was the tech stock issue. We dropped 2.7%, which was our biggest drop for 16 months. And this is about interest rates in the US, which are likely to increase. And increasing interest rates is bad news for tech stocks. And the reason for that is many of them don't make a profit or make very little money. And investors are being willing, in such a poor returning environment on cash, to move their money into these tech stocks. But now with interest rates increasing, they're giving up a better return potentially in the bond market, might be hitting 2%, whereas the tech stocks might not produce a return for some time. Also, we're seeing other shares that might perform better now as the US economy goes into more of a growth mode, and they might be travel and retail. So you're seeing people move out of the tech stocks into other investments. The thing for investors to remember is share market volatility is inevitable. It's just part of investing, but successful investing for the majority of us should be boring. It should actually be long-term diversified, and it's better to get your thrills and endorphin releases from somewhere else than the stock market.
I reckon there'll be lots of day traders that wouldn't be so sure about that, but good advice anyway. Hey, the reports of the mass truckies and warehouse workers isolating with COVID-19, what sort of an impact did that have this week?
Well, this is a huge issue for 2022. You think about not everyone can work from home. So due to isolation or contracting COVID, in some places, 25 to 50% of their workforce can't present for work. So what we're seeing, not only can the product sometimes not be produced, but now it can't easily be delivered, say to supermarkets. So that means when it gets there, the supermarkets are also short of staff and have difficulty packing the shelves. Then we have the consumers go in and go, oh my goodness, empty shelves, and they panic and then try to buy more goods. And this will continue for some weeks. The other issue, Dan, is we're also seeing some of the labour costs go up significantly. There's many essential services, think aged care, they have to have people there to look after the vulnerable, the elderly. And the costs of providing some of those services is becoming quite a burden. You're also seeing restaurants can't open because of unable to get wait staff or chefs. Plus, we're almost putting ourselves into a mini lockdown because people are nervous, and we've seen consumer spending drop significantly in the first week of this year as people, not because they haven't got money in the back of their pocket, we know in macro level there's significant savings, some hundreds of billions of dollars, but people are now nervous to spend. So this is a big issue for 2022.
And just on a couple of the points that you made there, we've seen broader supply chain issues, particularly around rapid antigen tests. But at the same time, supermarkets are now, in some instances, putting limits on how much you can buy, like what happened when we had the toilet paper fiasco.
Well, they're certainly saying that there's going to be enough products for the basic needs of families. And so they don't want us to panic and strip the shelves. So I think those restrictions are pretty essential to make sure we get through these next few weeks of challenges in this supply chain issue, because I don't think it's going to go away in the short term.
Look, there's also been renewed discussion about interest rates and a closer look at the RBA could be on the cards.
This is another big issue for investors and borrowers for that matter. The Reserve Bank continues to advise they're not intending to increase interest rates this year, but the markets at certain areas feel differently. You're seeing bond yields go up, that's the payment from bonds, and so it's signalling that the market's concerned interest rates will go up. You're seeing term deposit rates. If you shop around, you can get over 1%. Hard to believe, I think that was exciting, but for 12 months or more now. And you're seeing, from a borrowing point of view, fixed interest rates go up. The issue is that I want people to remember that interest rates increasing at this point is probably a good news story overall, because it would only increase if unemployment is low, if wage growth is strong. So it's signalling the economy is strong. So we actually do want a little bit of rate increase would be good.
And of course, the challenge that we'll have is for those people that have bought new properties and perhaps overextended is a big issue. I know that you've talked about in the past. Look, just to round us out, lithium prices, what's happened this week?
A massive rise in lithium prices, and this was about lithium is one of the core components for battery storage, and this, among other things, was around the electric vehicle sales, which last year actually increased by 160%. So that inevitably meant that there was a scramble to lock in lithium, and certainly the companies that mine lithium had a wonderful time on the stock market. It is considered that this might be a short-term thing, and as years roll out, that lithium price will settle back, but it's had a phenomenal run over the last 12 months and certainly this week.
Yeah, my word, it has. Suzanne Haddan, Managing Director of BFG Financial Services. Great to have you along. Many thanks.